I welcome all of you to this session today. I think we have three experts. I will try to keep my inputs to the least and have you have more inputs coming to you from the three experts who are present. Hi, Prateek, Vetri, and Prashant. $10 change in oil is about 0.5% extra CAD deficit, current account deficit for India. And that is something that can clear the pitch for India. So I think we are at a very difficult time, and I'm sure views from people like Prateek, Vetri, and Prashant will be very useful at this point in time. So let me start off with Prashant. Prashant, if the inflation worldwide and in India stays high, and in India we know that there is still that WPI at a different zone and CPI at a different zone, and therefore there's always this worry about inflation. And if the geopolitics gets worse, do we run the risk of stagflation from here? Do you even think about it, or you don't think that's a possibility?
I think, KVS, I think it's a very pertinent question what you have raised, and good afternoon, everyone. See, I think India runs slightly differently from rest of the world, and we have seen time and again that the correlation between India's economic growth and rest of the world is extremely poor. And a good example I can give you of that was what happened post-Lehman. Even in that year, Indian economy still grew some slightly more than 5%. So I think Indian economy seems to be on a strong wicket. I mean, consumption is growing steadily, albeit a bit slowly. Investment cycle is slowly reviving. And I think the opportunity of shift in manufacturing from China is a real one. Coming to oil, I think, see the way I would look at it, if you see right from 2007 onwards, oil has been around $70 to $100, barring a year or two. And India's oil intensity has come down from above 4% of GDP way back in 2007 to under 3% because oil demand grows slower than the volume growth of the economy. On the other hand, the software exports have grown quite well. So I look upon software exports as a counterbalancing force to oil imports. And of course, if oil prices stay where they are today, $105, $10, it could put some pressure. But that I think is a open issue yet. I personally feel that the Ukraine and Russia are large exporters of energy and grains. And the challenge is not of supplies, the challenge is of logistics because insurance companies are unwilling to write insurance. So whenever this war ends, and I am assuming it will end in the next 5, 10, 20 days, I think shipping will come back to normalcy over next few weeks. Then I feel we should see some cooling off in commodities. Structurally, though, I feel that the world has underinvested in energy, driven by concerns around ESG for last 5, 7 years. And therefore, oil prices may well remain higher than where we have seen over last few years. And last point on this, see, the equity investor in the Indian environment should not worry inflation because inflation for an equity investor is literally a pass-through. Higher inflation means higher nominal GDP growth. It means higher growth of companies, and that is what we have experienced in India over last 4 odd decades. But yes, if you talk of the world, if interest rates go up and if inflation remains, I think it could lead to some challenging outcomes outside India. But as I said earlier, I feel by and large, India should remain fairly insulated from that. Yes.
The markets seem more nervous. If that is the view, the market should not be as nervous as they are. But anybody you talk to, of course, still seems optimistic. So I do see some disconnect in that too. But how do you see that?
I think, see, I mean, all I can see, I mean, you can see the headlines slowly shifting. And that is what I have observed, that crisis periods seldom last long. Storms don't last long. The war may drag on for some more time, but I think the intensity of it should peak out in the next week, 2 weeks, 3 weeks. Because, see, these are not wars that are internal wars. These are two countries that are fighting. And I think, I mean, I could be wrong, but I do feel that in the coming few weeks, this should be behind us, either through a ceasefire or whichever way. But I do think a war on a large scale war could end. Resistance could continue in pockets here and there. But this mainline war, I do feel. But as you said, if things get out of hand, then clearly my view would be incorrect.
Right. Um, Let me come to Prateek. Prateek, some of these are, there are always in these situations unknown unknowns, and I don't know how these sanctions are going to work and whether they continue post the end of hostilities, but the sanctions do continue. And I was reading yesterday somewhere that the aircraft leasing companies are likely to lose $10 billion, and there none of that is Russians, right? All the aircraft leasing companies are outside Russia, and they're going to lose $10 billion. So there are things which we don't realize what will happen and what will hit you, and really unknown stuff can hit you. So do you see any risks of that kind to the market globally as well as to India, in anything that comes to your mind that we should be cautious about at this time?
Yeah, so let me respond to it, in two parts. One, how the world is responding to it, and how maybe we are responding, and how maybe we may benefit. So one, crazily enough, the world is forcing asset managers to sell at the bottom. First they impose sanction, asset prices fall, and then they are forcing asset managers to get out of that country, including, even businesses to get out of that country. So that way, if you see, Russians may be buying businesses cheap, or maybe getting better market access to themselves. There are always, two parts, two sides to the same coin. Now, it is my belief that somebody else's war is everybody else's profit. Yes, risk aversion goes up and money is may be directed elsewhere, but profits should not get impacted. If you look at the Russian economy, $1.8 trillion. If you look at Ukrainian economy, 185 billion, put together 3/4 the size of Indian, probably 2/3 the size of Indian. Our imports from Russia, 5.8 billion, just 5.8 billion. Our exports, half of that. So we are net importer. Now, look at it this way. The world is refusing to do business with them, but not stopping oil. There is no substitute for Russian oil. Okay. They're making them desperate. And who is standing to benefit is China and India. So, one thing is impact on global economy. Yes, a 2 trillion economy doesn't do anything, goes down by 20-30% in 1 year because of whatever is going on. It takes some amount away from global growth. I get that. But for X of Russia and Ukraine, global growth stays the way it was or gets better by a tad. Okay. Second, in terms of profits, pharmaceuticals, where we export like $400 odd million may get impacted a tad, and maybe company wise, if you see, tea, coffee companies may get impacted by a tad. We export 100 million there. Otherwise, direct impacts very less. And profit-making opportunities are emerging. If we as a country are able to buy Russian oil cheap, there was a news report yesterday which says China and India are looking to do that, and maybe IOC has bought a 3 million barrel this thing at $20 to $30 cheaper. What you make will sell at international prices. So that is margins and profits, and markets respond to margins and profits. At the end, while the journey may be volatile. And similarly, if the world refuses to do business with them and we set a ruble gateway like we did in the past, it is actually going to be possibly a great opportunity for India. It's still early days, but it could be good for Indian businesses in this manner. And of course, if there are supply disruptions, Prashant was saying what they export, wheat, metals, oil we don't have, but wheat and metals, our guys can get better export markets. FCI is like full of wheat that nobody knew who will consume. Now suddenly they have an export market where they can sell at a profit. So I do believe that on the macro, because of higher oil, maybe our growth goes down by 0.5, 0.6%. If we get it cheaper, lower. But in terms of profits, if we play it well, a quarter's impact here and there, but overall it could just open up some possibilities if this thing continues. But I do agree with Prashant, these things can't continue for too long. You run out of some resource or the other. 20, 25 days, 30 days on the outer side, I think, some resolution has to be found of whatever is happening.
Now, it's slightly more confusing, right? Everybody is wondering whether growth will remain an agenda and therefore rate hikes will be curbed, or will the central bank still have to look at interest rate hike? And what do you think next 6, 12 months, 15 months, how will this play out? Because this is very critical for the markets, right?
Sure. So I think the first thing we have to recognize is that every central bank is going to have a different dashboard with a different set of concerns that it will have to address. I think increasingly the sense, as well as the way the US policy is looking, clearly they have been slightly behind the curve. And I think they have struggled with this issue of changing a previously announced course of action. So very strangely, even though in November they said we will retire the term transient, we need to start thinking about rate hikes, they're actually continuing to buy bonds. They haven't backed away from buying bonds. And now you have this strange situation in which the market is talking about 7 or 8 rate hikes by the end of the year. To my mind, I think the US will be under pressure to hike because they are behind the curve. But in India, maybe this is an RBI governor who for the first time can look at his dashboard, and rather it will be the Monetary Policy Committee, and take some comfort that our indicators are in much better shape, and therefore we can shape our monetary policy to the requirements of our economy rather than overly worry about what the US is doing.
Markets are down after, I don't know, I didn't notice the index today, 10 to 15%, 15% from their peak, right, already. So do you think it is time for people to buy?
Right. With this sell-off, I can at least see 3 metrics which have come back into fair value. Again, I'm only saying fair value. I'm not saying they are cheap. But at least large cap valuations have now dropped back into fair value territory. So my comfort with large caps has certainly gone up. The only point to add to that would be, because we are dealing with probabilities and not with certainties, anything that you do, I would focus on large caps, but I would stagger. And to complete, mid caps and small caps, I don't think have dropped into the fair value territory on any indicator as yet. So I'm still a little bit cautious on that side.
So that's great. Prashant, you have also been a big proponent of value investing, right? And so your position on this, do you think markets have corrected and there is opportunity just now? Stagger allocation into what sectors, like Vetri said?
What I have observed in my experience is that over long periods, there is a strong correlation between long-term returns and the starting point of starting valuations. And to that extent, I believe that if you buy equities today over a 3-5 year period, returns should be in line with nominal GDP growth rates in India. And as I said, inflation is a pass-through for the equities investors. So maybe 12-14% kind of CAGR we can expect over the medium to long term. Coming to sectors, I mean, what stands out for me is consumer is very expensive. And I feel, a large part of the undervaluation in corporate banks has been corrected, a large part. And I think what continues to remain very cheap is energy, conventional energy. And it will be interesting to watch how that plays out over the next few quarters.
Right. Financials are close to 40% of the index, and they're significant sector within the market. How do you see that playing out? What is your view on that sector itself?
I think, two, three things I would like to point out. One, the credit cycle, the NPA cycle is clearly behind us. I think everyone agrees on that. And the way these things work, the next credit cycle should be 5, 7, 10 years away. So I think the bank balance sheets are clean, asset quality is good, provisioning cost should be very low over the next few years. The second thing is the loan growth continues to remain weak. And that is a bit disappointing. That's the only concerning part in the Indian economy. CapEx should pick up, lead indicators are suggesting, but as of now, credit growth remains weak. Corporate balance sheets are extremely healthy. Deleveraging is still probably continuing because cash flows to CapEx is quite high. But given the way economy is poised, given the way inflation is panning out, I think over time, credit growth should pick up. And that should be a very good period time for the financials. Low provisioning costs, good cost control, and expanding top lines. Rising interest rates are good for lenders because you are able to pass on faster than your cost of funds goes up, and 30-40% of balance sheets banks are in CASA. So I think the operating environment for banks, profit growth outlook for banks is quite good for next couple of years. I think the shift to digital banking will support the large banks because they will be able to defray the technology costs over a much larger balance sheet. And the ability of large banks to write small loans has gone up exponentially. I think the competitiveness of the large banks has improved vastly in this period. So I would expect market shares to consolidate faster in that space. The third point, FI selling financials have borne much of the brunt of this selling because it was clearly the biggest, the most owned sector. So we have seen, I think, significant correction there. The sector has underperformed, and that's why I feel more value has emerged in this space relative to other parts of the markets.